Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial jungle. And let me tell you, YELP Inc. has some interesting moves in their latest filing, especially when it comes to how they're spending their money. Before we dive in, if you like digestible insights from these corporate documents, hit subscribe. We also have a Discord community linked in the description below, where we break down more reports like this. So let's get straight to it. Yelp ended the 30th of September 2025 with about $989 million in total assets. That might sound like a lot, but here is a closer look. They had over $550 million in current assets, meaning things that are easily turned into cash. That includes over $231 million in cash and cash equivalents, and about $102 million in marketable securities. That is good to see they have readily available funds. Now, their property equipment and software is valued at about $90 million. This includes a significant chunk of around $339 million in capitalized website and internal use software development costs. That is the money they've spent building and improving their digital infrastructure. Imagine that as the digital storefront and engine of Yelp. Then there is goodwill, a hefty $135 million. Goodwill typically comes from acquiring other companies, and it represents the premium paid over the fair value of the net assets acquired. This tells us Yelp has been active in acquiring other businesses and sees value beyond just the tangible assets. Speaking of acquisitions, we'll get to that later. It is quite a story. On the flip side, their current liabilities hover around $184 million. A big part of that is accounts payable and accrued liabilities, which is over $168 million. This is the money they owe to suppliers and for various accrued expenses payments that are due soon. Now let's look at stockholders' equity. This is where the owner's stake in the company is shown. They have additional paid-in capital of almost $2 billion. This is money invested by shareholders above the par value of the stock. It is a huge number and shows significant investment from shareholders over time. But then we see accumulated deficit of over $1.2 billion. This means that since the company started, it has spent more money than it has earned cumulative losses over its history. It is common for growth companies, but important to note. Moving over to the income statement, let's talk about the money coming in for the 3 months ending the 30th of September 2025. Yelp brought in $376 million in net revenue. That is up 4% from the same period last year. And for the first 9 months of 2025, total net revenue reached over $1.1 billion, a 5% increase year over year. So the top line revenue is growing, which is generally a good sign. But what about the cost to generate that revenue? The cost of revenue excluding depreciation and amortization and some other things came in at about $36 million for the quarter. This is up 12% year over year. That increase is largely due to higher revenue share payments from their Repairable acquisition and increased advertising fulfillment costs. Sales and marketing, which is often a huge expense for tech companies, was about $150 million for the quarter. That is up 4% year over year. This increase is mainly from higher employee costs, including those from the Repairable acquisition. Product development costs were about $78 million for the quarter, staying pretty much flat compared to last year, a slight increase of 1%. For the 9-month period, though, product development costs actually decreased by 4%. This suggests they might be managing development expenses more tightly or capitalizing more of those development costs, a detail we saw mentioned in the footnotes. General and administrative expenses saw a decrease of 8% year over year for the quarter, falling to about $45 million. This was largely due to a significant impairment charge last year related to subleased office space that didn't repeat this year. Depreciation and amortization expenses went up quite a bit, 34% for the quarter, to about $12.5 million. This is a consequence of the Repairable acquisition and increased capitalized software development. All these movements led to an income from operations of about $52.8 million for the quarter. That is a healthy 13% increase year over year. And other income net, which includes things like interest income, was about $5.3 million for the quarter. This is down 26% compared to the prior year, mostly because of lower interest income due to smaller cash balances and lower interest rates. Their provision for income taxes was about $18.9 million for the quarter. That is a 22% increase, reflecting their higher profits, which all boils down to a net income attributable to common stockholders of about $39.3 million. That is a modest 2% increase from last year. For the 9-month period, net income reached over $107 million, a 19% jump year over year. A pretty solid performance there. Now let's dive into some key metrics. Ad clicks for the quarter declined by 11%. This is a big number and can be concerning. They attribute this to tough economic conditions and competition, especially in the restaurants, retail, and other categories. It sounds like customers are being more cautious with their ad spending. But here is the interesting twist: average CPC, meaning the cost per click went up by 14%, even though fewer people clicked on ads. Advertisers were willing to pay more for each click. This is thanks to increased advertiser demand in the services categories where Yelp seems to be performing strongly. This is a classic case of supply and demand in the ad world. Fewer clicks but higher price per click can sometimes balance out revenue. Speaking of services, revenue for this category was up 7% for the quarter and 9% for the 9 months. This seems to be Yelp's sweet spot right now, with growth in home and auto services. The RepairPal acquisition seems to be contributing to this growth as expected, bringing about 2 percentage points of overall advertising revenue growth. On the flip side, restaurants, retail, and other revenue saw a small decline of 2% for the quarter and 4% for the 9 months. This category is clearly facing headwinds. The report mentions challenges from food ordering and delivery providers, as well as macroeconomic pressures. And the number of paying advertising locations for the quarter is 512,000, down 2% year over year. This decline is driven by the struggles in the restaurants, retail, and other segment, which accounts for a significant portion of these locations. The services segment is growing, though, adding about 3% more locations. Now, about that RepairPal acquisition in November 2024, Yelp acquired auto services platform RepairPal for around $80 million. The goal was to boost their presence in the services categories, and it looks like it is starting to pay off in terms of revenue contribution. There is also a significant legal matter, the CA Pay action. This was a class action lawsuit related to privacy. Yelp reached a settlement for $15 million, which was fully approved in April 2024. They set aside and then released this amount as the settlement was paid. While it is a large sum to settle a lawsuit, it seems it is now behind them with no admission of wrongdoing. It is also worth noting some leadership trading plans. Their chief financial officer, David Schwartzbach, and board member Christine Barone have entered into trading plans. These are often put in place to sell shares over time in an orderly fashion and are meant to comply with insider trading rules. So what is the big picture here? Yelp is navigating a mixed economic landscape. Their services category is a clear bright spot showing solid growth, and the RepairPal acquisition seems to be integrating well and contributing to revenue. However, the restaurants, retail, and other segment is facing pressure from economic conditions and competition. The increase in ad clicks is a concern, but the higher cost per click is helping to offset that, for now showing some advertiser demand. The company is investing smartly in its platform, especially with AI initiatives like Yelp Assistant to improve user experience and drive engagement. They're also managing expenses, though. Some areas like cost of revenue are increasing due to strategic investments and acquisitions. Overall, Yelp is showing resilience and focusing on strategic growth areas. The accumulated deficit is still a factor, but the increasing revenue and operational income signal progress. The key will be to see if they can continue to grow the services segment and find ways to reignite growth, or at least stabilize the restaurants, retail, and other categories while managing their expenses effectively. Alright, that is our deep dive into Yelp's latest financial report. What do you think about their strategy and financial performance? Do you see them overcoming the challenges in the restaurants, retail, and other segment? Let us know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate insights. And for a deeper connection with our community, join our Discord server, linked in the description. Thanks for watching, and we'll catch you in the next one.